What is the best entry for a trend following trading strategy? Today we're going to take a look at the different stages of a trend and how do you find the right place to get into a trend, when it's too late, when it's too early, and everything else that you need to know. But first of all, welcome. It is Tuesday, which means it's Tradeciety Tuesday. So I don't only release a new video, but there's also a new podcast. And in today's or this week's podcast, I talk about the stages that it takes to go through from amateur or losing trader to profitable trader in 12 months. So make sure to check the link in the video description below and you will find the podcast there. So now let's get into this week's video. So I've prepared a lot of charts and we're going to dive into the charts in just a moment. But when we're going to take a look at trends and different stages of a trend, you will see that there are different ways how traders approach it. And many amateurs are stuck here in the first stage. It is too early. And this will probably sound very familiar to many traders. I know that I've been stuck there for quite a long time in the beginning when I started trading. And I will show you exactly how to find the right entry, what it takes to understand trends. So let's get into the charts. And first of all, let's just take a look at here. I've prepared an example. We are on the 1 hour time frame, but the principles can be used across all the time frames. And later, at the end of the video, I will show you also a higher time frame approach, and also we go to a much lower time frame. So a lot of amateur traders, when they just look here at the right side of their charts, what they see is that there is a long downtrend. And then here, what do you see? You have a pin bar and you have a small green bar. Wow, look at this downtrend. This is the first time that we're actually seeing a green candle. So what do amateur traders think right now? And I'm sure many will be able to relate. So there are three things that will go through the mind of the average amateur trader. First, the price and the trend has gone down so long, it can't keep going down forever. This is something that many traders think when they see a long downtrend. Second, many traders believe that when you get in early, the reward to risk ratio will be huge. And this is obviously true. If you can catch a trend at the bottom, at the turning point, then your potential reward to risk ratio theoretically will be very high. And third, I don't want to miss the uptrend because I've already missed the downtrend. So many traders who have missed what has happened here, price going to the downside, are sitting on the edge of their chairs. They're ready with the finger on the mouse button to get into the trend because they have already missed it, so much money they could have made, so they don't want to also miss the uptrend. And many traders will approach a trend in this way, and especially in the first few months, some traders, maybe even a few years, they will be early trend chasers, and this is too early. This is catching a falling knife. This is where I left off. Here, the first green candle, and you can see the price kept making lower lows afterwards. We just didn't have enough information. And just because there's a very long trend and just because there is a pin bar and a green candle, it's not enough confluence and not enough information that you should be going long. So as you will see during this video, when we're going to follow this trend, you will see that we're building confluence. We are trying to build and stack information upon information so that we can understand and follow the trend as it progresses and then hopefully also turns around. So let's fast forward a few candles. And what do we see now? This is the first time that we paused. Now we have a very nice RSI divergence. You can see the price kept making lower lows and lower highs. The RSI is giving us a divergence. That's great. Now what do we have? We have an even longer downtrend. So again, the traders think that this downtrend has been going on for such a long time. I've already lost here maybe one time on this trade. So I don't want to miss this trade when the market is finally turning, and it has to turn. It can't go down forever, right? That is what many traders think. And now you even have the divergence on your side. So let's go long, right? However, what you see a few candles later, this is where you have the divergence. This is when we left off. Now the market keeps making lower lows. And again, this is too early. Although the price here showed some loss of momentum in the downtrend, so we can clearly see that the price didn't drop as fast as it did here. The trend didn't drop as fast here because we also have the divergence, and that's exactly what the divergence tells us, that the price action and the indicator are not agreeing, the momentum is going down or it's losing momentum. However, the trend structure at no point was broken, so the market kept making lower lows and lower highs. And an indicator divergence just tells you that the trend is slowing down. It doesn't mean that the market is going to reverse. It just means that the trend that you see on your charts is slowing down. So let's fast forward, and now what do we have now? So now we still have our divergence, point 1. Now, however, something significantly has changed. And now you can see, whereas previously we kept, or the price kept making lower highs and lower lows, now we have a higher high. This candle broke through the last 2 highs. So we have an active trend structure change. Higher high, a strong breakout candle, and the longest bullish streak that we have seen. So look at here, those candles, a lot of bullish candles. And when we look at all of the downtrend, at no point did we see that much bullish influx. And never have we seen that much bullish momentum over such a short period. And those things are really what separate, obviously, the very, very way too early trend entry from those still too early trends. Of course, you may make them work if you get in here, and although the market may have not made a higher high, it doesn't mean that always will the market take you out. For example, you put your stop loss below the last low that you've seen. Your reward to risk ratio may be potentially huge. However, the drawback is that it will also reduce your win rate. And I've talked about this in the past. There's always a trade-off between reward to risk ratio and win rate. The earlier you get into a trend, the fewer information you have, the fewer confluence factors you have, which means also that your win rate is going to go down because you don't have as much information and the trade is not backed by that much information. So the win rate will go down and the reward to risk ratio will go significantly up. However, as I also said in previous videos, this kind of trading strategy is very, very difficult to trade for amateur traders because it requires a very different and a very stable mindset. Low win rate, high reward to risk ratio. Theoretically, on paper, you can make this work. You can trade a low win rate system, no problem. Many professional traders do that. However, the low win rate component is really what is going to eat away at your mental capital. And if you have a lot of losing trades in a row, it is very hard to still maintain your high level of chart analysis and your high level of just mental resilience. And you are more prone to revenge trading, to chasing trades, to just get too emotional after a string of losses. However, maybe you have a trading system which has a 30% win rate, but your average reward to risk ratio on your winning trades is maybe 6 or 7 to 1. Then, even if your win rate would be 25%, you could still make this work and make money over the long term. However, can you really trade that from the win rate perspective? And most amateurs can't do that. So it is important, and I would always recommend it, that you get into not those too early trend trading strategies, but early. You can see the market has made a higher high. We haven't made a higher low yet, but there are still a lot of things that are coming together here that indicate that this time it is different actually than what we have seen previously. And a few candles later, you can see this is here where the price made a higher high for the first time. Now the market kept rallying higher. So what do we know now? Now we know we have a higher high as indicated here. And we also have a higher low as indicated here. Last low here, higher low here. Is it still okay to enter a trade? Yes, maybe. You are in wave 3. So here is wave 1, wave 2, wave 3. So you are entering in wave 3. And whereas it may not be an entry that is too late, you are now trading a mature trend. When you look at general Dow theory, on average, trends keep on going for around 5 trend waves. So if you are getting in early on in wave 3, you only have this last trending leg that is going to go for you, on average, of course. So you may not get a lot more out. Your reward to risk ratio may be not as large. However, because now you have a lot more information that you are actually in a bullish trend, now you have higher highs and higher lows. Now your win rate may go up significantly, but your reward to risk ratio will go down. And this is also something that many traders struggle with. Of course, it's great to have a high win rate, but you have to understand a high win rate usually goes hand in hand with a lower reward to risk ratio. And what do amateur traders have problems with? Amateur traders have problems with accepting smaller reward to risk ratios. You always want to swing for the fences, you always want to go for the home run and have those big, huge winning trades. But if you are a trend trader that gets into a trend on a wave 3, you don't have as much that you can expect from price going forward. And a few candles later, you can see this is where wave 3 was. You can see the market did make a little bit higher highs and higher lows, but compared to the first entry, there's not as much here that we made here on the way up. And now we are in wave 5. 1, 2, 3, 4, 5. So now on average, if we listen to average Dow theory, wave 5 is when a trend is likely to be over. And amateurs now think again, the price has gone up for so long, it can't keep going forever. And when I get in early, the reward to risk ratio will be huge, and I don't want to miss the downtrend because I've already missed the uptrend. So a lot of traders, so there are two parts. Many traders will now get into a short trend, especially because, or a short trade rather, especially those who have missed the uptrend or maybe lost money here in the uptrend. So the same what we have seen here, the traders that get in too early will also get too early here on the way down. However, there's also traders who will chase the market on the way up. Maybe they've seen, wow, a lot of traders made a lot of money here on the way up and I completely missed it. So I will just get into a trade maybe now, or if you just got in, you will leave your trade running for too long and not get out of your long trade. And a few candles later, what has happened? The market just moved sideways, which is very frustrating. And many traders will lose a lot of money here during those ranges. And this is generally how the thinking of amateur traders goes. You will often be too early, you will often be too late, and then because you are losing money on the way down, you're losing money on the way up, or you're not missing, or you're missing out and not making any money. This is just overall very frustrating. So a few tips on how to improve your trend trading skills. First of all, I would recommend add a moving average because it's an objective tool. So I use the 50 period moving average here. This is the same chart on the 1 hour, and we can nicely follow here this trend. On the way down, this is where the downtrend ended. This is where I highlighted here the breakout into new highs. Here on the way down, or on the way up here actually, this is where the uptrend then ended and the market entered a sideways range. So you can very nicely see when is a trend over, when is a new trend starting, and it works in both ways. My second tip, use a higher time frame as an addition to your lower time frame analysis. A higher time frame can help you understand and choose the direction in a very effective way. And this is what I trade. I trade a multi-time frame trend following approach. So for example, we have been looking previously at the 1 hour, and now we are here on the 12 hour. You can also use the daily. I have added a Bollinger Band, and you can see this was the previous downtrend, and you can use the Bollinger Bands here, for example, for looking for spikes outside of the Bollinger Bands. You could go for the 4 hour higher time frame in combination with the 1 hour and look for exhaustions. When is the market not able to push into Bollinger Bands? I made a few videos on how to use Bollinger Bands, so make sure to check that out as well on my channel. And as a third tip, you could also execute your trades on a much lower time frame. So you can make your analysis on the 4 hour, 1 hour, and then go to the 15 minute, for example, where you can then time your trades using the microstructure. So here we are on the 15-minute, same chart, and I added moving average channel, which I also talked about in previous videos on my YouTube channel, so make sure to look for them. And what you can see here is that you can very nicely follow this trending structure using the moving average channel. And essentially what you want to look for is those break and retests into the direction of the moving average channel. And you can use them to time your trades using a breakout approach. So every time the market breaks into a new high, you could go in. You could also look for pullbacks. When is the market pulling into previous resistance, now using it as support? That could be also a way. And this is then how you could then use the moving average channel to ride your trends and stay in profitable trades as long as the moving average channel is still holding up. So we have a few options: higher time frame, lower time frame, add indicators such as a moving average, which then can help you have a more objective approach to trend following in general.